Welcome back, grade 10s. Today we will look at year-end procedures. What does a business do at the end of a financial year? If you remember correctly, we spoke about the accounting cycle in grade 9. Businesses have transactions that they enter onto source documents. The receipt, the check counterfoil, invoices. We use these source documents to draw up journals. Once the journals are drawn up for each month, we then post to the general ledger. The general ledger is posted to at the end of every month. Once we have drawn up the general ledger, we see if it is correct by drawing up a trial balance. The trial balance can be used to draw up the financial statements at the end of a financial year. What is a financial year? A financial year is also known as an accounting period. This is 12 months. The 12 months don't have to start from January through to December. They could also start on the 1st of September to the 31st of August the following year. Or they could start on the 1st of March and end on the 28th of February the following year. As long as a business has a 12-month period for their financial year, it could start from any month on the calendar. Financial statements are drawn up at the end of a financial year. The income statement is drawn up to indicate whether the business has made a profit or a loss. So we add all our income and we subtract all our expenses for the entire year to indicate whether we have made a profit or a loss. The balance sheet is then drawn up after the income statement to indicate our financial position. We need to find out whether our assets exceed our liabilities. Financial statements are used as reporting documents, so they must be able to tell the reader of financial statements everything about the business. So who needs to read financial statements? The bank, potential creditors, potential investors, as well as the owner of the business. So, financial statements must have applied the GARP principles. In our previous lesson, we spoke about GARP, Generally Accepted Accounting Principles. So, owing to the fact that the business's financial statements are read by a variety of stakeholders, in other words, the bank, potential creditors, potential investors, or the owner, GARP principles have to be adhered to when drawing up the financial statements. At financial year end, the business needs to make certain adjustments so that their financial statements are GARP compliant. We make these adjustments in the general journal at the end of the financial year. We then have to post to the general ledger to update the affected accounts so that our GARP principles are applied to our financial records to make them GARP compliant. Some adjustments you've already done. For example, bad debts. Bad debt is an adjustment. You also made an adjustment for the owner taking goods for personal use. So you already know 2 adjustments. So let's look at our accounting cycle now. Once the general ledger is drawn up and we then would have a pre-adjustment trial balance. After the pre-adjustment trial balance, we then can use those balances and totals to make the necessary adjustments so that we are GARP compliant. We would then post back to the general ledger and then draw up a post-adjustment trial balance. We use our post-adjustment trial balance to do post-closing transfers, and we then draw up a post-closing trial balance. We then will be able to draw up financial statements at the end of the year. We are only going to concentrate on adjustments for now. Okay, so what do adjustments look like? Adjustments are journal entries necessary to make our financial statements GARB compliant. I've already told you this. So I'm going to give you an example of one GARB principle that we need to apply. The matching concept. The matching concept tells us that expenses and incomes must be reported in the correct time period. So, for example, the business could have a tenant that has not paid his rent, and by the end of the financial year, this money is still owing to the business. But we've got to go and apply our matching concept. It says that income and expenses must be reported in the correct time period. We know that rent is income. And even though the tenant has not paid us, that income applies to the current accounting period. Therefore, we need to adjust our books to show that it is income, even though we have not received it yet. So, this means that we need to make an entry in our general journal to show that the rent needs to be increased, therefore we credit rent income. We also need to show that the tenant owes us money, so we've got to enter it into an account called income receivable. This will show up in our balance sheet that the tenant owes us money. The rent income will show in our income statement as income for that financial year.